Welcome. My name is Benoit Paleke. I'm the founder and one of the portfolio managers here at Exponent Investment Management. We're going to cover in today's videos the second quarter review. We've broken it up this time around thanks to your feedback. The first one kind of sounded like me giving a university lecture, which brought me back to 20 years ago. And my apologies, it was kind of boring. So we're trying to mix it up. We're going to make a shorter video. Just all you need to know for what happened this quarter and how it influenced your portfolio. And for those of you that like more in-depth research, we've laid out all of the data and charts for you in a second video. Thank you so much for your feedback and thanks for watching. Enjoy the video. So let's get started, shall we? The performance of the past quarter has been nothing but historic. As bad as the first quarter was, the second quarter was its mirror image. So if we look at, so we've changed the layout a little bit for you. What we've got here is sort of the indices going down and then the performance for this quarter so far in 2020 and the 12-month going back to, if you will, the end of the second quarter of 2019. If we look at the Canadian market, the S&P Total Return Index up 17%. We're still down 7.5% this year. The real story really for 2020 so far has been the performance of the technology index, up 26% in Canadian dollar terms for this quarter, still largely positive for the year of 2020 at 17% and up 30% year on year. Europe, very similar to Canada, and the emerging markets all around still negative markets, still negative prints for the 12 months, but still some substantial bounce back, if you will. Canadian dollar still around 75 cents. We closed the quarter at 74. Last year, end of December, we're at 77, around 76 12 months ago. When we look at the oil price, which is interesting, we've got $40 as of $39.27 as the close, down from $61. You think, wow, that's a pretty drawdown. But as we all know, the oil price during the second quarter traded in a negative fashion. I won't get into the technicals of it. Let's just say that really the real print or the real low, if you will, should be $12 or $15. The VIX is still quite elevated at 30 or over 30 at 31. The average should be, on an average market, should be around 15. The other really interesting story or storyboard to follow is the yield on the 10-year government bonds were 0.5%, and we were at 1.6 or 1.5 a year ago, 1.6 in December. The negative yield curve is now gone. We still have a positive slope, although very small, and the negative curve is now behind us. In the US, the yields are still low. You'll notice in Canada, the yields are actually lower than they are in the US. So despite low rates in the US is one of the jurisdictions with the highest yields, even if you've got 0.66 as a print for the 10-year bonds at the end of the quarter, down from 188 and even 216 a year ago. The yield curve in the US as well, they had a negative yield curve, but it was over a year ago, whereas we are still, or ours was negative for a longer period of time. So the narrative for this quarter, in Canada, low interest rates, clearly we talked about that. Oil prices are on the rebound. Public health efforts, effectively shutting down the part of the economy that is retail facing or client facing. That had some ramifications. So if you own restaurants, even office workers were sent home, as we all know. Government intervention, positive impact in terms of getting people or the economy to not completely shut down. So we had $2,000 a month going out to wage support. We also had wage support on the part of employers. We had another program for rental, commercial leases. So these programs really were meant to get the economy at least limping through. Similarly, in the US, lots of similar programs. We had initial hotspots that obviously made the news in New York and Washington State. So those are under control. As of the moment of this recording, we're having regional hotspots flare up in Texas and basically the U.S. Southwest, California, and Florida. One would argue maybe those areas really never completely shut down. It's not the point of this video, but let's just say that we've got hot spots. Life back to normal in the U.S., that remains to be seen. Racial tension, anytime you have an economic shutdown and you have tensions that percolate through. So we had some of that, and that impacted the markets. In the rest of the world, Europe is reopening. In fact, if you want to travel, Europe, a lot of the European countries are attracting or inviting Canadians to come over. Asia is reopening. One would say they even won the first battle. Unfortunately, South America, the Middle East, and Africa are still deep in a COVID-19 siege, if you will. So let's get started about the other part. We talked about the government interventions. So let's talk a little bit about that. So we've got, the title says central bank intervention, but really you've got two types of interventions. One is fiscal. So that's really the government talking about getting involved in the economy. Some would say helicopter money. So we've got, trillions of dollars in the US, represents 15% of the GDP, or the economic output. In Japan, they went very hard. They are suffering with a slow growth going into this. The economy in Japan was not turning over quite, it was not growing for other factors. And so they felt it was important to have significant stimulus. In Europe, still important stimulus and probably more to come. In Canada, our stimulus package was 14%. So again, quite significant on a percentage basis, equivalent to what the US has done. On the monetary side, so the fiscal side is really what the government's willing to do. So call it helicopter money, tax breaks, tax deferrals, all those types of measures. Monetary is what the central bank does. So the central banks, obviously in the US, lowered rates. The other important, and really why the markets turned around, is they basically ensured that the credit markets would continue to function. So the central banks effectively said, we will buy all and any assets in bond assets or credit assets as required. In Japan, similar story. They even got involved. They were already involved, but increased their involvement in the actual stock market. So some investors are expecting the US Fed to do the same. It actually has not said so far. Rates in the US or in Europe have gone negative, continue to increase the asset purchase. In the UK, similar story, purchase of bonds, rate cuts. In Canada, same story, rate cuts and purchase of bonds. So another theme that I think is very important is if we look at the concentration of the S&P. So as we move forward here, most money managers in the US have not kept up with the S&P 500. And a lot of it is due to this phenomena of the concentration. So right now, as the end of June, these 5 companies, Microsoft, Apple, Amazon, Alphabet, and Facebook, which really are all technology companies, make up 17% of the S&P 500 in terms of their value. And it's happened before. It happened back before the last crisis of 08-09, let's call it the Great Recession. We had an oil stock, GE, which was an industrial, Microsoft again, AT&T, and Procter & Gamble. GE is obviously far away from it being the top in top ranks, if you will. ExxonMobil as well, AT&T as well. So Procter and Microsoft are the only two that are close to still being, let's call it top 15. We go back to before the tech wreck. This is, again, technology. Microsoft, Cisco, Intel, 3 of the 5 were technology, and then we had GE and Walmart. So it's interesting to note that the 5 largest companies in S&P 500 are all technology companies, and they are actually, it's more prevalent than it was during the tech boom of the early 2000s. Going back to the 90s, we had, again, Walmart, GE, and AT&T. So there's always a change in leadership, But whenever the leadership is as concentrated as this, 17% in this case, as of now, it's very hard, because if you're building a portfolio, a diversified one, you might have 2, 3, maybe 5% in each in a given stock. So let's look at valuation. This is a new chart that we've introduced as well. So what we're trying to illustrate here is the market expensive or not? So as this market has gone up in value, there's been a significant portion of investors, us included, that have been sort of more cautious in terms of chasing this market. So if we look at the forward PE, so basically you're looking at the earnings expectations, and you're taking the index and dividing the two. So you've got right now the S&P trading at 19, that's almost 20 times forward earnings. Where does that look like? What does that look like in terms of the high of the past 5 years and the low? Well, back in March, we traded at 12 times, and the peak was 24 times in September of 2016. The earnings, well, they've come down. They were marked down. It took a while, say the low of March in the markets, and basically back all the way through June, earnings were marked down as companies would come to market and lower their guidance. In January of 2020, just pre-COVID, the earnings expectations were $1,100. So obviously, what do you learn from this? Earnings expectations are all over the map, and they're slow to adjust. They're slow to adjust on the upside and on the downside as well. The S&P earnings is effectively the PE reversed. And what we're trying to do here is compare, if you were to buy the S&P TSX at the end of the quarter, what would your earnings expectations be? How much money would you make as a shareholder? And you would make 5.24%. You would lock that price in, assuming that the earnings are coming at $623. If they come in higher, you're going to make more. If they come in lower, you're going to make less. And the idea is to compare that risk, if you will, that variable risk, versus what you lock in if you buy a 10-year bond. Assuming, why do we use 10-year bonds? You're assuming that you would be an equity owner for 10 years. If you buy a bond in Canada, if you bought it at the end of the close of the quarter, you would be locking 0.5%. So even though the markets are expensive, they're still cheap relative to the other alternative, which are bonds. Again, the high on the earnings yield was 8.3. Obviously, the markets were down. And back in March, you were locking 98 basis points. And back in September, the lowest we've seen in the past 5 years at 5%, yields were 1.88. So again, you're locking in, you're still getting paid for the equity risk in Canada. In the US, the S&P earnings expectations at the close of the quarter is 125. If you go back to last quarter, that's more or less where we felt the earnings would come in, and that's really where the earnings expectations are currently. The high was $175 back in January pre-COVID, and back in September, $117. So we're really back to 2016, 2017 types of earnings level. On an earnings yield, again, if we're reversing the PE, we're looking at, assuming that the earnings do come in at $125, you're locking in a 4% earnings yield. Compare that to the bonds at 0.66. You're still, as an equity owner, getting compensated for the risk. The high in the past 5 years had been 7, and the low is 534. So we are making a new low here on an earnings yield. Important to note. Remember, though, a lot of these earnings, or most of the earnings, are driven by the technology sector. So what are the life lessons? The first one, I think, is the most important one, is this concept of binary thinking. So will something happen or not? Is the color red or is it blue? Is it true or is it false? In a crisis, and when you read the media, the information is always presented to us in a binary fashion. When investing, you really, and in life and in science, you really want to talk about a probabilistic approach. So what are the possible outcomes, the most likely outcomes? And you might come up with 3 or 5 scenarios, and you want to assess or try to pin a probability to those outcomes. It makes understanding what's going on. Otherwise, if you just follow the binary outcome, you will make some changes, some dramatic changes. And since we're in the middle of a pandemic, there's a lot of new information coming out about the disease. I mean, experts are learning on the fly. Science is constantly evolving. And so it's important to stay open-minded to different outcomes. Governments have reacted. I think we can all agree, especially in Canada, that from a public health perspective, the measures have worked. But there doesn't mean that the governments are forward thinking. So a lot of you are worried about the added debt levels or the borrowings that it took to make or finance this government intervention. And that's the subject of another video. But let's agree that many investors are looking to governments to solve a lot of this pandemic issues. And most governments are usually reactive. They're not forward thinking. Pre-COVID, post-COVID, that remains the case. Also, unfortunately, this issue has been politicized, both at the municipal, provincial, and federal level. And so there's a saying in politics, you never waste a crisis. So again, on the news flow and the narrative, just be very careful from an investor's perspective that you want to filter out as much as you can the quote-unquote crisis that is going on. It is by no means a crisis. It is certainly a crisis, but a lot of what we would consider noise as investors is played up in the media. Some trends are accelerating. I would say that's where most of our work is being done, is trying to understand the trends. So which ones are long-term? So working from home, one would argue, is a long-term trend. Others will say, well, maybe we're going to come back to work when we're allowed to, but it's going to be more of a hybrid model. Takeout and cocooning, these are trends that were pre-COVID, existed pre-COVID, same as work from home, really. Others, the love of traveling, of cruising, of restaurants, that's obviously been on pause. Will it come back, and under what form? This is really the most interesting part of the investment research that we're doing right now. This, unfortunately, is true. The strong sectors, the strong companies get stronger out of it. Why? Well, two reasons. One, the competitive landscape is much weaker. And the second one is these companies and these operators tend to spin off the check, if you will, if I can use a hockey analogy, as hockey is about to start, hockey playoffs are about to start, and really trying to pivot, which is another MBA word that I don't like using, but at the end of the day, they take they take the crisis and actually make it into an opportunity. Many will criticize them for it, but strong companies do adapt very well. Weaker companies, think department stores, were weak going into this COVID-19 crisis or pandemic, and it just got weaker. Torque, and that's going to be the subject of another video. But the concept is, if you make an investment, if you buy a stock, how much torque or exposure do you get to a particular outcome? So that could be a reopening outcome, a bearish case where COVID is with us for the foreseeable future, and we have to learn with it. All of these different underlying outcomes. So as we build a portfolio, how much torque do we want to one of these possible scenarios? So let's talk about our scenarios of strategic outcomes. We came up with three. The first one is science wins by Christmas, the economy roars back. And you can see when in investor reactions, when there's good news on the vaccine front, market goes up, and certain sectors do absolutely well. So travel, restaurants do very well when there's positive news on the vaccine. What we think is the most likely scenario at this juncture, at the time of this recording, and obviously we were open-minded to changing. We learned to manage. There's some flare-ups, but really by the time the vaccines are found, if they're found, as the time of this recording, there's over 100 vaccines being worked on from in various phases. So there's a lot of brain power, a lot of human effort going into finding a virus. So let's assume it takes 24, 30, or even 36 months to both find the virus, test it, and manufacture it. In the meantime, we're going to have these flare-ups, just like we're seeing in Florida and the US Southwest and certain communities here in Canada, and we learn to adjust. And that's going to be our new normal. The bearish case, which for many investors is easier to understand because it's what we've been through most recently. It's called a recency bias, which is, COVID-19 is with us for the foreseeable future. We have no vaccine. And it's a possibility. I mean, HIV is a virus and there is no vaccine for it. We certainly adapted and science has developed therapeutics and HIV is no longer a death sentence. But we adapt to Mother Nature, not the other way around. Our new normal is clumsy, and from an investor standpoint, what does that mean? It would mean that the economy is probably running at 80 or 90%, and there's some sectors that are simply heavily curtailed or simply not functional. The other one is the unknown unknowns. That's an interesting one, and it's really about, well, think of it. We've got elections coming in the fall in the US, possibly in Canada. We have trade wars going on. We have China's push in terms of geopolitical influence. Lots of stuff could go on. So how do you build a portfolio for all of these 4 strategic outcomes is what I'm going to go through in the next slide. So under the first scenario, you'd want some exposure. So the first scenario, if you remember, is science wins by Christmas. So what do we see here? So commercial real estate would come back to life, live entertainment, oil and gas. Why? Because the economy would roar back. And because of the lack of investment in new wells, if you will, into COVID, there would be a supply imbalance. Basically, demand would spike and supply would be short for a while at least. Travel and leisure would come back, transportation, restaurants, and banking. Scenario number 2, which is sort of a clumsy new normal for 24 to 36 months. Healthcare would do well. Obviously, all the efforts, all the money poured into the search for vaccine technology, the work from home, companies that do not need to rely to see customers or have customers come into the place of business. That's clearly, you can see currently that is the thesis for investors right now. Consumer discretionary, online retail. Why consumer discretionary? Well, there's a portion of the population that continues to work, continues to earn a wage. And so because of restaurants being shut down and travel being shut down, those dollars get redirected to other parts. So currently in the summer, it'd be home improvement and things like leisure, like RVs, boat sales, those types of consumer discretionary expenses. In the winter, obviously you don't buy an RV in the winter, but it might be an RV park, or it might be a new TV, or that type of discretionary spending. Online retail, clearly for obvious reasons. Direct to consumer brands. So we've done a lot. So something like Nike or other brands, or Vans or North Face, or these brands that have great penetration in their market and do not need to be distributed by department stores. Telecom, entertainment, content, and industrials, because of the economy, because of this consumer discretionary still being built on the consumer end, there still needs to be some inputs on the front end. Scenario number 3, which is the bearish scenario. We were with COVID for a while, so the elevated market would probably fade. You'd want to have exposure to consumer staples, food production, retail, and food retail, utilities, and continued even more focus on work from home and other technologies. Scenario number 4, which is the unknown unknowns. In order, you need to adjust. You'll want some cash, you'll want some high quality bonds, high quality stocks, and a certain amount of liquidity in order to readjust your portfolio. That's it for today. Thank you so much for watching. If you have any questions or comments or feedback, please let us know and by email. Thank you so much for watching. I'm Benoit Poliquin for Exponent Investment Management.